Well, good morning, everyone. Good morning, you're welcome to class. All right, who do I have here? Good morning. It's 11:45 already, and our class is starting right away. All right. All right, good morning. How are you doing? Good morning. I see that somebody just joined us. Good morning, how are you? I need your response. All right. Since we have limited time, I believe we can jump right into what we plan to do today. All right. Let's see if this is working well. Yeah, perfect. All right. So in our previous lecture, we talked about control accounts. All right, and in that lecture, I explained everything that you need to know about control accounts. We talked about what control. So all right, so we talked about what control account really is. We dived into control accounts fully and all of that. I explained what you mean by sales control account, and then I also explained, sales ledger control account. Then we also explained what we mean by purchases ledger control account. All right, and if you'd see that most of our other what's it called? You can find them on Padlet. All right, you can find all of the other details on Padlet. Is that fine? All right. So don't forget, I promise you guys that in our next lecture, I'm going to solve a question on control account before we move on to the next topic. So here we are. That's why we are here to solve questions before we move on. All right. If you guys are on the call, I need your response. I just I can see that some people just joined, but you guys are not saying anything. Oluwatimileyin, good morning. Good morning. Is this your first time in my class? Because this is the first time I'm seeing you. I think it appears as if we are going to have new guys here. So let me drop the Padlet link again. For your information, there is a question on Padlet. All right. Good morning, Oluwatimileyin. Is this your first time? All right. This is your first time. You are welcome to tutorial prep for account. In actual sense, we have done a number of things, but I'm sure that where you met us, you would also be able to relate. But of course, you are still allowed to ask questions. If you have any questions based on what you have been reading and you did not understand before, you can just do well to reach out. All right, like so, just drop your question here, and then you see this link that I posted. All right, this link that I posted is our Padlet link. If you click on it, there is a place where you can upload your questions. You can ask questions from me. You can upload anything you want to upload. Do you understand that? So that Padlet link, um, you know what? All right, so I think you can see the Padlet link. So in this place, on this link, you can actually what? You can ask questions. So we have a test here. I dropped the link to the test question. It's something that you can attempt. All right. So you should attempt it immediately after this class. All right. So then you see us. I dropped rules of sales ledger control account. I dropped rules of purchases ledger control account. Transactions that cannot be posted to the control account. We did all of this in our previous lecture. All right. And then test results released. So it's also possible for you to, once you click on this link, you can also ask questions here. You can drop your question and then I will solve it and drop the explanation and the answer to it. So you see this button. All right. So just click on this button. If I click on this button now, can you see it's telling me that I can ask a question? I mean that I can post something. So you can write a subject if you want to. By putting it here, you can upload an image, you can upload a link. All right, you can search for image and any other attachment type. So if you click on this, you see many other things that you can upload to use to just to ask questions. Do you understand that? All right, so that's the way that works. So if you have any question, you can always drop it here, and I will be there to always respond and answer your questions. Is that fine? All right, all right. So that's that about the Padlet link. So we'll be dropping questions over and over and over and over again. All right. More questions and more questions and more questions and more questions and more questions would be coming to the Padlet link. So do well to take advantage of it. I hope you understand that. All right. So if you have any friend that is also enrolled in this place and then they are not here yet, do well to reach out to them. All right. So let's go back. Let me share my. All right. So I've explained control accounts. We said, let me just, because you are just coming in the next few minutes, let me just give you a brief introduction, or let me say a brief summary of what we learned under control account. Now, we said control account is a memorandum account. What do you mean by memorandum account? It means that it is not essentially part of the double entry um, process. All right. So it is a memorandum account. Let me show you where we wrote it. All right, the balance of which reflects the aggregate balances of many related subsidiary accounts which are part of the double entry system. So it means that the control account can be seen as a what? As a summary account, all right? Or you can also see it as what? The total account. Because what it does is that the balance in the control account gives you, it shows the aggregate balances, that is the sum of all the balances of related accounts. So if you have your total debtors control account, for example, the balance in the total debtors control account gives you the total of all balances in the individual debtors account. So if we have 5 debtors, we have Mr. A, we have B, C, D, and E. Alright, by the time you add all of these balances, it will give you the same thing as what you have in the total debtors control account. That's basically what we mean by what? Control account. Do you understand that? So it is a summary account and it is known as the what? The total account, because it gives us the total figure for what? For various related other accounts. Do you understand that? All right. So and then another thing is that you must know it is a self-balancing ledger. Then we looked at some advantages of control account. All right. Then sources of information for control account. Where are the places where we see information for control account? Mention that we have receivables and payables account, return inwards and outwards, bills payable and receivable, dishonored checks, cash paid to payables, and cash received from receivables, and so on. Then we explained what trade receivables or sales ledger control account is. All right. Now, another thing is that Oluwatimileyin, if you can hear me, you can go ahead to watch the videos. All of the videos of the past lectures are on your dashboard. So just go there, click on the link, and then you can rewatch all of the videos from the beginning to the end. Do you understand that? All right. So that will work better even than the summary or the revision I'm doing for you. Just go back and watch the video. All right. So I promise that we are going to solve one question before we move on to the next topic today. All right. And this is the question that we are going to solve. This is the question that we are going to solve. I want us to solve it real quick so that we can move on to the next topic. Is that fine? Any question? Do you guys all right? I've never explained. Sorry. So extracts from the books of JKO Limited shows the following balances for the month of June 2022. So we have sales ledger balance as at June 1, 2022. That's what? 4,702. Are we still together? Are we still together? Are we together? So this is the opening balance, all right? So we have opening balance for sales, for sales ledger control account, and the opening balance for the purchase ledger control account. We have sales journal balances. Now, these sales journal balances, don't forget, what are you going to have in your sales journal? You know, another name for sales journal is sales day book. So what we have here is what? Our credit sales. Do you understand that? So it is our credit sales. Your purchase journal balance, this 40,800 is your credit purchases. Don't forget, I said, it is inside your sales day book that you record your credit purchases and credit sales. Sorry, you record your credit sales in your sales journal, your sales day book, while your credit purchases go to your purchases journal or purchases day book. So when you see purchase journal balance, you know that we are talking about credit purchases. Then we have returns inward, return outward, received from customers. All right, that's cash received from customers. We have discount allowed, payment to suppliers, discount received, then bad debt written off. Then we have sales ledger set off. All right. Then we also have purchases ledger set off. Then on June 30, 2022, it was discovered that a supplier was paid twice in error for 157 naira. The amount was refunded on that date. So we are required to prepare the sales and purchases ledger balance control account as at July 1, 2022. All right. So we have two accounts to prepare. All right. So we have two ledgers to prepare. We have the sales ledger control account and the purchase ledger control account. All right. Now, the best way to prepare this is to actually do it simultaneously, or we can actually do it. We can we can decide to do it one by one too. So I think let us do it one by one. Sales ledger control account. We have JKO Limited. Ratimile, are you still with me? All right, so sales ledger control account. All right, all right. So sales ledger control account. Now, what will be the first thing? We have, don't forget, your sales ledger control account is the same thing as total debtors control account. You can also call it trade receivable control account. Do we understand that? So just in case they bring out the question anyway. So the balance brought forward, that's the opening balance, let it be here. Balance brought down, otherwise known as balance brought forward, is how much? That's the balance as at the beginning of the year. That's June 1, 2022. So we have 4,702. All right, 4,702. Then don't forget, okay, now the summary of what I said. Under the rules of sales ledger control account, you will see it on your screen. Is that this is it o. Anything that increases debt will be debited to the sales ledger control account, while anything that reduces debt will be credited to the sales ledger control account. So that's the rule that we are using. You look at every transaction that we got. Is it going to increase debt? If it's going to increase debt, I mean, when we are talking about increasing debt, I'm talking about the debt of, I mean, if for sales ledger control account, if it's going to increase the indebtedness of our debtor, then we put it where we debit it to the sales ledger control account. Now, if it's going to reduce the indebtedness of our debtor, then we credit it. So that's, we are still using the same words. We are using the same format. So sales journal balance, I told you guys that that is credit sales. All right. Is that increasing your debt or reducing your debt? Credit sales is increasing their debt because as they are buying goods on credit, their debt is increasing. So where is it going to be? Debit side. So we come here, it's how much? 37,437. So come here, you say credit sales, 37,437. Let me have my calculator on standby. Calculator on standby. All right. So purchase journal balance, you know that that one is going to purchase ledger control account. We have returns inwards. Now ask yourself, is return inwards going to increase debt or reduce debt? If you return goods, if you bought goods for 50,000 naira, you are owing that person 50,000 naira. Once you return goods, your debt will reduce now. Do you understand that? So return inwards is reducing debt, so it will be on credit side. So we come here, 910 naira. We say return inwards, 910 naira. Is that fine? Now we have received from customers, that is, we receive cash from customers. So your customers are your debtors, the people that paid, sorry, the people, all right, the people that bought goods from you on credit. Now, when they do this, what happen? When they buy goods on credit from you and then they pay you, it means that their debt is what is reducing. So debit or credit? Credit. So 38,529 We say cash received from customers. Oluwatimi, oh, sorry about that. It's a mistake. Oh. You cannot have two debit. Oh. It is debit and credit. Do you understand that? I'm sorry about that. So cash received from customers or from debtors, 38,529. I hope you have your notes with you and you are following me as we are doing this. Now the next one, we have discount allowed. Now when you issue discount to your customer, are you increasing their debt or reducing it? You are reducing it. So it's going where? Debit side. So discount allowed 1345. Credit side. Sorry, oh, it's debit and credit. That was a mistake from my end. So discount allowed. Then we have payment to suppliers. That one is not coming here. Discount received not coming here. Irrecoverable debt written off. That's bad debt. All right. Bad debt means that you sold goods to somebody, somebody owes you money, but you can no longer retrieve that debt. That debt is irrecoverable. You cannot recover it anymore. So it has reduced the debt, your total debt. Do you understand? Because now you are writing it off that this person can no longer pay. So you remove it from debt and you just treat it as an expense. So bad debt, 115 naira, is coming to credit side. Irrecoverable debt or bad debt, 115. Are we together? So that's that. Then we have sales ledger set off. All right. Sales ledger set off or contra. We said contra entry or set off. It happens when we have to set the sales ledger off against the purchases ledger. So that means that we have a customer that is both a supplier and a customer. Or we have somebody that is both a customer and a supplier. That means we have bought goods on credit from that same person. We have also sold goods on credit to that same person. So we are both owing each other. Do you understand that? So when you have set off, of course, set off is going to reduce the debt. So sales ledger set off, you have to put it on credit side. Set off. How much? 209. But the thing about set off is that set off is going to affect the two accounts because you are saying that you are setting sales ledger off against what? Against purchases ledger. Do you understand that? So even as we have credited sales ledger set off to the sales ledger control account, we have to go and debit purchase ledger control account. Purchase ledger control account to purchase ledger control account will also be debited to purchase ledger. All right. And if we debit it to purchase ledger control account, then so if we credit it to purchase ledger control account, we have to. So you come back here, you say set off. What's the second amount? 110. Do you understand that? Do you understand that? Any question? All right. So now let's reset on June 30, 2022. Oluwatimileyin, I'm with you. Do you have a question? All right, I'm so sorry for that break. Can you see me now? Can you see the screen now? Oluwatimileyin, are you there? Confirm that you can hear me now. Can you hear me now? Hello there. Are you guys still there? Sorry for the transmission issue from my end. The transmission issue was from my end. Are you there? All right, let's just hope that you guys are there. All right, so set of 110 and set of 209. So with this, now we have something else. On June 30, 2022, it was discovered that a supplier was paid twice in error for 157 naira. It means that we paid the supplier that we wanted, somebody that we were owing 157 naira, we paid him two times. But they said the amount was refunded on that date, which means that he has refunded the money. But this one does not affect sales ledger contract account because suppliers, sales ledger contract account is talking about debtors, but supplier is a creditor to us. Do you understand that? So let us close this and see whether we have a debit balance or a credit balance. All right. If you add this, you should have 42,249. 42,249. All right. By the time you add all of this, what are you going to have? You have 41,108. So if you add this plus this plus this plus this plus this, you have 41,108. I hope you guys are also right punching your calculator. Then your balance carried down. It means that your debit side is greater than your credit side, so you have a debit balance. Don't forget, the debit balance occurs when your debit side is greater than your credit side. While your credit balance will happen when your credit side is greater than your debit side. So balance carried down is 42,249 minus 41,108. That gives us 1,141. Do you understand that? So can bring it down here as at July 1. Balance brought down 1,141. Oluwatimileyin, you said no. Is it, what are you saying no to? You don't understand or you don't have any question or what? I can't respond. I'm moving to the next one. So purchases ledger control account, because of our time. We have debits. Okay, all right, that's fine. Purchases ledger control account. All right. So for this one, let's start this one together. We have sales ledger balance. You know that one is not needed here. Purchase ledger balance, we need it. That's as at June 1, 2022. So that's our opening balance. So don't forget, your purchase ledger control account, we have a credit balance. So you start from the credit side. So you say balance brought forward. And that balance brought forward is how much? 2,757. All right. Now, if you see what I posted on the account, you see that rules of purchases ledger control account, you see that anything that is increasing debt, that is, our suppliers are the people that customers are the people that owe us, but suppliers are the people that we owe. So anything that increases our debt to our suppliers has to be credited to the purchases ledger control account. For example, credit purchases. All right, but anything that reduces that debt, all right, will be what? Will be debited. Do you understand that? E.g., cash paid to creditor. So this is the rule that we are what? That we are using. So coming back to the table now, to our slide now. So you would see, all right, so we have recorded this one, we don't need it. Purchases journal balances as at June 30, 2022, we have 40,800. Don't forget, I told you guys that this is what? Credit purchases. Is credit purchase, if you buy goods on credit, is it increasing your debt or reducing it? Of course, it is increasing, right? So we come here, we say credit purchases. Is that fine? Now, how much is that credit purchases? We have 40,800. Are we together? So let's go back to the question. On returns inwards, we have used it, that it does not belong here. Returns outward, that is reducing debt, just like returns inward. So you come here, you say returns outward. Don't forget, another name for returns outward is purchases return. Another name for returns inward is sales return. So we have 749. All right. Now the next one, we have discount allowed, received from no, discount allowed no, but we have payment to suppliers, that is the amount of money that we paid to our suppliers, that is reducing our debt. All right. So what do? We come here, since it's reducing, it comes to debit side. So we say cash paid to suppliers. That's how much? 35,415. Are we together? All right. So come to the next one. You have discount received. Now, if you receive discount, it means that your supplier is telling you that they have removed a portion of the money that you are supposed to pay, so you are not paying less. So that's reducing your debt. So it's also going where? To the debit side. So discount received was 746 naira. So you come here, you say discount received 746. Is that fine? All right. So discount received, yes. Irrecoverable debt, we don't need that. Then sales ledger set off 209, purchase ledger set off 110. So you see that one set off here is on the credit side, debit side. According to double entry, every debit entry should have a corresponding credit entry. All right. So this one we go where? So you come here, you say set off 110. Then there's another set off that is on the credit side here, so it has to come to debit side here. It said 209. So the thing about set off is that it's going to affect both purchases ledger control account and what? And sales ledger control account. Do you understand that? So that's the way set off works. All right, all right. But let's see, are we actually done? Let's see if we're actually done. It says that on June 30, 2020, it was discovered that a supplier, we made payment to a supplier for 157 naira, but we paid it twice. So they had to refund us. All right. So this is the way it works. This money that we paid to suppliers, cash paid to suppliers, we paid 157 naira twice there. So we have to, they now refunded it to us. It means that we are what? We are receiving money. The money has to reduce, we are using it to reduce the amounts that we paid. So to serve as, since this one is on the debit side, the other cash refund will be on credit side. Although by the time you watch the video of the last lecture, you would see the explanation of it. I wrote out the format and I explained it, so you see the explanation. So 1, 5, 7. All right. Now let us balance this account. You come here. All right. There is a very great likelihood that the credit side will be greater than the debit side. So by the time you add everything here, you should have 43,824. Then you have balance carried down. By the time you add all this, you have 749 plus 35415 plus 746 plus 29. That's 37,119. For 3,824 minus 37,119 gives us 6,705. Then our balance brought down or brought forward, as the case may be, is 6,705. And literally we are done with control account. So that's the question for me to solve for you guys. All right, any question? Any question? Any question on this? Any question on this? I want to move on to the next. You fully understand. No questions. You fully understand. All right, so let us move on to the next topic. Just give me a few seconds to project the. Just give me a few seconds to project coming. All right, so can you see my slide now? I think you should be able to see my slide now. So these are the questions. Sorry, this is the next topic. So please, I need your response. Do you have any question? Any question, any question, any question before I move on to the next topic? Any question whatsoever? All right. Now I want to ask you another question. Since you don't have any question from me, let me ask you a question. What are accounting ratios? Accounting ratios. If you ask what is a ratio, what is an accounting ratio, what would be your answer? Any question? Sorry. What are accounting ratios? I'm waiting for you. Oluwatimileyin, what are accounting ratios? Any other person before we enter into the topic? It's actually a very, very simple topic. It's just filled with formulas. You just have to know the formulas and you are good. But of course, you also have to understand what it stands for. And actually, you see, when you actually understand it, you would be able to um, derive the formula even by yourself. So, who wants to explain? Who wants to tell me what accounting ratios are? All right. Oluwatimileyin said accounting ratios are financial metrics used to evaluate a company's performance and position. They are financial metrics. I love your use of English. That's fine. Okay, actually, you are right. And that's basically what ratios are. They are financial metrics used to evaluate a company's performance and position. All right. You used deep English there. All right. Now, I'm breaking it down to the simplest way it can be. Now, ratio is one number expressed in terms of another. When you are talking about ratio without putting the accounting and all of that, ratio is just you expressing one number in terms of another. So it's like you are dividing something by another one. Do you understand that? So if I say 1 over 2 now, 1 over 2 is the ratio of 1 to 2. So this should be 1 over, if it is 1 ratio 2, so 1 over 2, you want to find it how 1 relates with what? With 2. So it is one number expressed in terms of another. So 1 is expressed in terms of what? In terms of 2. It's as simple as that. You want to know the kind of relationship that exists between 1 and 2. Do you understand that? So it is used to measure the relationship between two or more figures, and accounting ratios are used to measure relationship between figures or items in the financial statement. So that's why ratio is actually the major tool. All right, see, it is used for analysis and interpretation of financial statement. So it's the major tool used for what? To analyze financial statement, to what? To understand financial statement. You see, it is easy for you to understand things. I mean, okay, let me give you an example. Okay, let me give you an example on the uses of ratios. Oluwatimileyin, let's assume that I gave you 5,000 naira. Let me ask you, if I give you 5,000 naira, will you be happy or sad? How happy will you be? Will you be? Yes? Are you going to be happy if I give you 5,000 naira? You don't know if I want to do giveaway o, but since you did not answer. Now if I give 5,000 naira to Oluwatimileyin, you did not reply me, so I don't know whether you'll be happy or not. But normally, you should be like, wow, at least free money. Even if you are rich and you have more money, at least free money is always sweet. So you'll be like, you will be happy. Now, if I give 5,000 naira, absolutely, just 5,000 naira, that's an absolute figure. But if you now look at it that, okay, let's look at it this way. Between if I give you 5,000 naira, if I give you 5,000 naira, and if somebody like Dangote gives you 5,000 naira, which one will you be happy more? Okay, you'll be happy if I give you 5,000 naira. Now look at it. If I give you 5,000 naira, you'll be very happy, you'll be grateful and all of that. But if Dangote gives you 5,000 naira, you look at it that out of the billions of naira that this man has, why is he giving me just 5,000 naira? That's entitlement, though. It's not kuku your money. But people are just prone to do that. They'll be like, and I know this person has high amount of money. Why is he not just giving me 5,000 naira? But you not say that if I give you 5,000 naira because you don't know the amount I have. You don't even know whether that's my last card that I'm giving to you. Do you understand that? So just as the same way, if I give you 5,000 naira, so you see, the what you are using to make decision there is because you are doing 5,000 naira, maybe my own net worth is 200,000, and you are doing 5,000 naira over 200,000, you're like, okay. But you're not doing 5,000 naira over billions of naira, you're like, that's a minute fraction of what he has. That is how ratio is used for what? For analysis and interpretation. So, or if, for example, ratio can also be used for comparison. If, for example, I give you 5,000 naira, and you now ask from your classmates, you now notice that I gave every other person, I gave them 50,000 naira each. By the time you look at it, you'll be like, even though you gave me 5,000 naira, you're still giving all of these other guys times 10 of what he gave me. So you calculate the ratio in your head that he's giving me 10% of what he gave the other people. What's wrong? Do you understand that? So that's the way ratio works. So ratio is used to analyze and interpret financial statements. So the same way if I interpret financial statements, all right, don't forget we said one other aspect of financial statement is interpretation. When I started this class, I told you guys that accounting is the language of business. But what that means is that if you want to think about that, you would see that not everybody understands the language of business. So if accounting is the language of business, then you should now know that not everybody does what? Not everybody understands the language of business. All right? Because of that, you have to interpret that language to some people. So assume that I came here today in this class and then I start speaking French. You might not understand French. I would have to interpret it. So when you bring accounting information to some people, it's always just messy and all of that. Nobody, especially if you are looking at an investor, nobody wants to read your tables, your long tables and all of that. You are still doing basic in, but when it comes to financial or very large companies, you just have a lot of numbers just thrown from here and there. You have financial statement that is, if you see their financial report, you are seeing 50 pages, 80 pages, 100. You're like, what's going on? Do you expect me to read all of these things? But somebody just comes here, analyzes the financial statement and brings you what you need, interprets it to you with the use of ratios. Then with that ratio, you don't need to look at every other figure. Once you use that ratio shows you the relationship between every figure in that financial statement. And once you see that ratio, you can now understand what is going on. Do we understand that? So accounting ratio shows the relationship that exists between accounting data. All right. So since it is used for analysis and interpretation, our analysis and our interpretation of financial statement will now help us evaluate whether the company is doing well or not. So that's where it now comes to Oluwatimilehin's point. The accounting ratios are financial metrics. All right. Metrics means measures. Financial measures, let me write it, or measurements that are used to evaluate a company's performance and position. You want to know how this company doing. If you want to know how the company is doing, create ratios for them. You can see the profit. Okay, maybe as we go on, I'm going to explain that. If you are seeing somebody making a profit of 1 billion, you're like, wow, that's a lot of money. But you now saw that the total number of sales that they made was 1 trillion. If by the time you do 1 billion over 1 trillion, that's 1%. So they are just making 1% profit. They are not doing well. Do you understand that? So that's the way ratios work. And also to make ratio work very well, we always compare it. Don't forget, we said one thing about accounting is comparability. We talked about it under the qualitative characteristics of financial statement. There are two fundamental qualitative characteristics. We have the faithful representation and relevance. Then we have 4 enhancing qualitative characteristics. That's verifiability, comparability, understandability, and timeliness. So comparability is now telling us for you to compare, you can prepare ratios for year 2023 and year 2024 just to see how things are going, whether there is an improvement or not. Do we understand that? So let's start with the most basic relationship that you can find in accounting. All right, and that's the relationship between profit and sales. Ask yourself, is what kind of relationship exists between profit and sales? We want to know, is this a toxic relationship or is it a nice relationship between profit and sales? This is the way we know. Now, of course, basically, you know that your selling price equals to cost price plus profit, and your cost price equals to selling price minus profit. Which means that, for example, you want to start selling goods. All right, to know the amount that you'll be selling, you first go and buy. Once you buy the goods, let's say you bought the goods for, you bought an item for 5,000 naira. Don't know why I'm using 5,000 naira today. Let me change to 7,000 naira. All right, 7,000 naira. Then you are thinking of how much should I sell this product? How much should I sell it? Now, it is the concept of markup and margin that helps you know how much you should sell this product. Now, this one is what? Is cost price. To know how much you want to sell it, you must first think, how much profit do I want to make on these sales? Do you understand that? When you I bought this thing for 7,000. I have to think, how much profit do I want to make? So if I think that I think it's just okay to make 2,000 naira profit. So you add 2,000 naira profit. You now sell it for 9,000 naira. That will be your what? Selling price. It's as simple as that. Do you understand that? So your selling price equals to your cost plus profit. Your cost plus profit equals to what? Your selling price. Your cost price equals to selling price minus profit. That now brings us to markup and margin. What does that mean? It means that in real life, you don't just pick amounts like that I want to make profit of 5,000 naira. It does not make sense. Profit are made in percentages. You can say on this product I want to make 10% profit. Can you see that makes sense? You see, the way it works is that numbers speak, but when you use ratios are not just absolute numbers. All right. For example, if you say you want to make profit of 5,000 naira on every of your product, it means that even the product that you bought for 50,000 naira, you also sell it for 55,000, and the one you bought for 7,000 naira, you sell it for 12,000 naira. It does not make sense. You will see that the profit on it is, of course, it looks the same in terms of absolute number, but it's not the same in terms of ratio. If you look at the relationship, all right. So that's why markup and margin was stated, to see the relationship between profit, cost, and selling price or sales. Do you understand that? So markup and margin tells us how these three relate together, how profit relates with cost, how it relates with selling price or sales. Do you understand that? Now let's start with markup. Markup is profit expressed in terms of cost price. It measures the relationship between profit and cost. So you can say the cost price divided by 100 to 1. So you are like, so this is 20% on cost. Do you understand that? You can say I want to make 20% on cost. Now, if you say 20% on cost, then you are putting your profit, you are tying your profit to what? To your cost. Which means that your profit will be expressed in terms of cost. That is what we know as what? As markup. So markup shows the relationship between profit and what? And cost. Do you understand that? I hope you are jotting. I hope you have notes. Profit and what? And cost. So that would now mean that, so if I make 20% on cost, then my cost is 20 over 100 or 1 over 5. Do you understand that? So let us say this example. Cost of your goods is 50,000 naira. Then you want to mark it up by 20%. It means that you want your profit to be 20% of your cost. That's what markup means. So it means that your profit will now be equals to 20 over 100 multiplied by what? 50,000. That will give you 10,000 if I'm not mistaken. Yeah, that should give you 10,000. Do you understand that? Do you understand that? This our time is running, and I don't know where it's running to. We still have a number of things to cover. I just in slide 3. But do you understand that? So your profit, if you say 20% of 50,000 naira, then so with this you can now get your selling price. Abi, if you incur cost of 50,000 naira and you mark it up by 20%, then it means that you sell it at 50,000 naira plus 10,000 naira. In order for you to make 10,000 naira profit, you have to sell it for 60,000 naira. Do we understand that? So it's actually as simple as that. So they might just want to, shake it somewhere and tell you that you have markup, calculate cost, and all of that. But we are going to deal with everything here. These are things that can also come out in your exam. Do you understand that? Now let's look at we are still on relationship. Now let's look at markup and margin. Now we have talked about markup, it's still the same thing. Now let's talk about margin. So margin shows the relationship between profit and cost price, but markup rather shows the relationship between profit and cost price. But margin is profit expressed in terms of selling price, which means that it is showing the relationship that exists between profit and selling price. And it is expressed as what? Profit over selling price. Do we understand that? So give me a minute. Right. So profit over what? Over selling price. Of course, in case you want to express it as what? As percentage, you can now say times 100 over 1. So sometimes you express markup as profit, markup and margin as percentage, sometimes you don't have to. Do you understand that? Just as I did here, a markup of 20% is the same thing as a markup of 1 over 5, because when you do 20% means 20 over 100. So that's 1 over 5. All right. So here, profit is expressed in terms of selling price. You want to see the relationship that exists between profit and what? And sales price. Do you understand that? All right. So this is the way it works. You can say, I bought. You can say you want to get a 10% margin. What does 10% margin mean? It means that you are saying that any amount of profit that you will get, it must be 10% of your selling price. So if I sell goods and the selling price is 50,000 naira, it means that I must make a profit of 10% on this. 10% of 50,000 naira gives me what? 5,000 naira. Do you understand that? So that's what margin is. So if I say I want my selling price, so I want to do 15% margin, It means that whatever my selling price is, I must be able to make profit that is 15% of that selling price. Do you understand that? So I think there's a question here that I want us to solve. When we get there, you would see it. So 15% margin on 50,000, that will now be, so don't forget 50,000 is selling price in this case. That will now be 15 over 100 multiplied by 50,000. What should I give you? 0.15 times 50,000. That's 7,500 naira. So you must make a profit of 7,500 naira. So now look at the whole relationship. If my selling price is 50,000 naira, so look at the way they can ask you. They will not give you margin. Now this is your profit. They can ask you to calculate the cost price. Cost price equals to selling price minus profit, which equals to 50,000 naira minus 5,000 naira. It means that you must have bought these goods for 45,000 naira. If your margin is, if you made a margin of 15%, then it means that your cost price equals to 50,000 naira minus your profit of 7,500. That makes your cost price equals to what? 37,000. Sorry. 42,500 naira. Do you understand that? Oluwatimileyin, do you understand? I need your response. I need your response. Do you understand? Do you understand? Do you understand? I need your response. Let this class be as interactive as possible. Do you understand? Should I continue? I don't know. Maybe after I've spoken, you used to hear like 1 minute later. I don't know. Because I don't know why you're not responding. I'm trying to teach you. I'm trying to be sure that you understand what I'm teaching and you are not responding. So how will I be sure that you understand it? Do you understand? If you don't understand, just tell me. I'll go over it. And if you understand, just tell me so that we will not waste our time. You are wasting precious time by not responding on time. So let's move on to converting markup to margin and vice versa. So we are saying that it is possible for you to convert markup to margin. That is, this markup, you can convert it to margin. What does that mean? Or why is it even necessary? Now, the reason this is necessary is that there are times that in a question they will give you markup. They will not give you with selling price. They will not ask you to calculate profit. That's impossible because you cannot apply markup on what? On selling price, because markup is profit percentage on cost, while margin is profit percentage on selling price. Do you understand that? So markup and sales cannot work together. Margin and cost price cannot work together. So if it now happens that they give you markup and sales, then it means that you have to transform that markup, you have to transform it to margin so that you'll be able to use that margin for sales. In the case where they also give you margin and cost price don't work together. You have to convert that margin to something that will work, which is what? Markup. So you convert margin to markup, then you apply that markup on what? On your cost. Do you understand that? So that's what we are doing here when you say converting markup to margin. All right. So if you want to convert markup to margin, the rule is simple. Just add the numerator to the denominator of the markup. And if you want to add convert margin to markup, just deduct the numerator from the denominator of the margin. That's just English. Nobody cares about all of this English. You have to understand it in terms of what? In terms of number. So let me show you how to understand it in terms of number, what it means. All right. So let's assume that you have markup just as we had in the other time. Markup equals to 20%. Don't forget I said 20% same thing as 20 over 100. Let's leave it this way. They now say you should convert this 20%. You want to convert it to margin. You see, I used to give a little formula here. I'll say that for markup to margin, if markup equals to numerator over denominator, therefore, this is not therefore. Therefore, margin equals to numerator over denominator plus numerator. It's as simple as that. All this add numerator to denominator here, you might not get it. But if you understand it in terms of number and formula, you are good. Just do numerator over denominator plus numerator. Don't tell me that you don't remember what numerator is. In a fraction, numerator is the one that is up. So this is our numerator and this is our denominator. So the one up is what? The numerator, while the one below the fraction sign is what? Is the denominator. So if I want to convert, if markup is 20 over 100, then margin will be n plus 20. That gives me 20 over 120. It's as simple as that. That's my margin. Do you understand that? That's my margin, and that's the way conversion of margin to markup works. So the thing is now that they might not give you in percentage. You can do it that same way. 20 over 100, break it down to the smallest, that's 1 over 5. So let us still do it here. If you now break this down, that's 1 over 6. And you see that it's still the same thing. So if you want to convert 1 over 5 directly, you say equals to numerator over denominator of 5 plus numerator of 1 equals to 1 over 6. The reason I'm doing n is I don't want you guys to make the mistake of equals to 2 over 7. Find margin. I hope we are still together. So if markup equals to 2 over 7, find margin. Margin will be equals to n over d plus n. That's numerator is what? 2. Denominator is what? 7 plus numerator again 2. So it means that our margin is 2 over 9. It's as simple as that. You don't have to. So markup and margin is one of the simplest topics that you can ever come across, especially in ratios, in accounting. So I don't want you guys to think there is something, and if you see it in your question, it's something that you should do in 1 minute. What am I saying? 1 minute? You don't have 1 minute. It's something that you should do in 10 seconds. You know, it's something that you can almost do it in your head without even using calculator. Once I see 2 over 7, I already know that if I see 2 over 7 as markup, I already know that it's 2 over 9 that is margin. And in JAMB, you don't even need to think about it. Just use your margin directly. Pam, 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 and you are good. So the other one, margin to markup. You can also transform margin back to markup. So I said, in case you see margin and cost, you know that margin and cost, they don't work together. All right. So you have to use markup and cost. So to get profit, you have to first convert margin to markup. Then you now apply the markup on what? On the cost. So this is the rule. Deduct the numerator from the denominator of the margin. This is what it means. If margin equals to n over d, that is, it has a numerator and it has a denominator, then markup will be equals to n over d minus n. That is the numerator. You have to deduct the numerator of margin from the denominator of the margin to get markup. Do you understand that? So if n equals to 2 over 9, then markup equals to 2 over 9 minus 2. It's as simple as that. If margin equals to 50%, all right, the markup will be equals to numerator, the same thing, over 100 minus numerator. So 30 over 100 minus 30, that will give us 30 over 70 equals to 3 over 7. And if you want to do this is 3 over 10. So if you still do 3 over 10 minus 3, you still have 3 over 7. Do you understand that? So it's actually that simple. There's nothing hard about markup and margin. So now let's take this example. If I move on to others, our time is far spent. So illustration, stock at the beginning, that's opening stock, is 800 naira, sales is 20,000, stock at close is 1,000 naira. I think I should just do it here. Using a uniform rate of markup. Now, markup is 1/3%. That's 33 whole number, 1/3 over 100. You need to make this thing complex. If you do 33 over 1/3 divided by 100, you get 1/3. Do it on your calculator. Do you understand that? So 33 over 1/3 is equal, 33 over 1/3% is equals to 1/3. 66 whole number 2/3% is equals to 2/3. So in case you see something like that in your exam, just you don't think once it's percent, 66 whole number 2/3% equals to 2/3. Test it with your calculator. There's nothing there. So if markup is 33 over 1/3% equals to 1/3, we have gotten that. Now it says stock at the beginning 800, sales and all of that. So using a uniform rate of markup of 33 over 1/3%, which you have explained to be 1/3, what they say you should do? Calculate these three things. Number one, calculate profit. Calculate profit. Now you see the issue that is here. Alright, they give us sales, but they give markup, and you cannot use markup to calculate profit with sales. So it means that you have to convert markup to margin. So step one, convert markup to margin. So if markup is 1/3, then your margin equals to numerator over denominator plus numerator. That gives you 1/4. Do you understand that? That gives you 1/4. So it means that your margin is 1/4. You can now calculate your profit. Your profit will now be 1/4 multiplied by sales, 20,000. That will give us how much? 5,000 naira. So profit is 5,000 naira. We have gotten that. This is number one. Now, number two, they told us to calculate purchases. Now, look at it. How can you calculate purchases from the information that you have here? It's pretty simple. All right. It's actually simple to calculate purchases. And don't forget to calculate purchases. Don't forget that thing when you want to calculate in your trading account, you have something like opening stock, add purchases, less closing stock. This will now give you cost of goods. So your cost of goods is the same thing as cost of sales. Are we together? So you can say something like cost of goods equals to opening stock plus purchases minus closing stock. The first thing would be that you have to calculate cost of sales, because now you are looking for, you don't have cost of sales and you don't have purchases. Do you understand that? So the first thing, let us we have opening stock, we have closing stock. We are looking for purchases and cost of goods sold. But from what we have done here, we can actually get our purchases. I mean our cost of sales. And why is that? It is because your cost of sales will be equals to cost of sales will be equals to sales minus profit. Don't forget that to get your gross profit here, you have to deduct this cost of goods sold from your sales. All right. So if profit equals to, don't forget the way we wrote it, sales equals to cost plus profit. So now that we have cost and we have sales and profit, it means that your cost equals to sales minus profit. So it means that cost of sales here equals to sales. How much is sales? 20,000 naira minus profit of 5,000 naira, and that gives us 15,000 naira as cost of sales. Do we understand that? So if your cost of sales is 15,000 naira, then your profit, sorry, your purchases. So we are now going back to this format now. You have 15,000 naira, that's cost of sales, equals to opening stock. How much is opening stock head? Plus purchases, we don't know it yet, P, minus stock at close, closing stock, 1,000 naira. You know those collect the lifetime. It means that you have 15,000 naira, 800 comes over here, you have minus 800, 1,000 comes over here, you have plus 1,000. That gives you what? P, which is your purchases. All right. And it means that your purchases equals to 15,000 minus 800 plus 1,000. That gives you 15,200 naira. And there you have it. Do we understand that? So that's that about cost of sales. Sorry, margin and markup. Please, I need a minute. So maybe I should come in. So do we understand? Is there any question? Any question regarding this? Our time is far spent. Any question? So give me a minute, but let me drop this. Convert markup of 2/5 to convert margin of 3/7 to markup if profit equals to 10,000 naira and cost equals to 70,000 naira. Calculate sales price and calculate sales price and margin. Yes. So please, I need a minute, but you guys should solve this question within that minute. These three questions that is on the screen. So Oluwatimileyin, are you still with me? Solve these three questions. I'll be with you in 1 minute, just 1 minute. So convert markup of 2/5 to margin. When you are done, drop the answer immediately. Convert margin of 3/7 to markup. When you are done, drop the answer. And if profit is 10,000 and cost is 70,000, and calculate sale price and margin. So I'm expecting your answer. I will drop the same question on Padlet too. I'm expecting your answer. All right. Give me a minute. All right, I'm back. Here's your answer. All right, for the people who will be watching the videos, I believe you should solve this before you continue watching the video in case you are watching the video. All right, I think let me drop All right. So you have that there. So the Padlet link is there already. I'm also giving you guys a minute. Actually, not up to a minute, 30 seconds. Go and, if you are in class, go and mark your attendance. This is what we show that you actually came to class. So, but of course, I know the people that are not also responding to me. If you like, tell me that you're in class. I cannot believe that you're in class, because I did not see your comments. So, what me I'm using is the comment of the people that I've seen here. Even Oluwatumine is not in class because they have stopped commenting. So, let's continue. Now, rate of stock turnover. Now, this ratio is used to measure the number of times stocks are replaced during a particular period. So, it is measured in times. So, you say 5 times, 2 times. So, your answer, for example, the formula is cost of goods sold over average stock. They now say times. So, if cost of goods sold over average stock equals to 5, then you say 5 times. All right. So we just want to know. All right. This is the way it works. We are buying stock and then we are selling them. Once we sell a particular stock, we have to replace it. We want to know in a particular period, maybe in a particular year, how many times did we replace stock? If we replace stock many times, then it means that we actually sold goods fast. But let's assume that during this year we just replace stock just one time. That means we did not sell much. But if we replace the stock like 5 times, that means we sold it out. That's because if you don't sell it out, you will not replace it. Do you understand that? So it is expressed as cost of goods sold over average stock. And your average stock, or don't forget, another name for stock is inventory. So they can call it average inventory, equals to opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by what? Divided by 2. Alright, so this is what gives you your average stock. Are we together? So let's see this question. It says stock at the beginning is 4,000 naira, sales is 50,000 naira, stock at close is 10,500 naira. Using a uniform rate of markup of 25%, calculate margin of goods sold, average inventories, and rate of stock turnover. This one is not hard. Markup equals to 25%, that's 25 over 100, which is equals to 1 over 4. Then it means that your margin will be equals to numerator over denominator minus numerator. That gives us 1 over, sorry, you are converting markup to margin, so you have to add. So that gives us 1 over 4 plus 1. So that's 1 over 5. So this is your margin, number 1 done. So if your margin is 1 over 5, then your profit equals to 1 over 5 multiplied by what? 50,000 naira. Profit will be what? 10,000 naira. Then the second cost of goods sold. All right. Don't forget how we calculated cost of goods sold in the other time. Do we understand that? So we know that cost of goods sold will be equals to sales minus profit. That will be equals to 50,000 naira minus 10,000 naira. That's 40,000 naira. Are we still together? All right. Then average inventory. Average inventory. Let me say this is 1, 2, 3, 4. Average inventory is same thing as average stock, equals to opening stock, that's 4,000 naira, plus closing stock, that's 10,500 naira, divided by 2. That's 4,000 plus 10,500, that's 14,500 divided by 2. This gives us 7,250. Is that fine? So the next way we should calculate rate of stock turnover. So our rate of stock turnover equals to cost. Don't forget the formula. You have cost of goods sold over average stock. All right. So what's our cost of goods sold? 40,000 naira. So we come here, we say 40,000 naira divided by average stock of 7,250 times. So bring out your calculator. 40,000 divided by 7,250. On my calculator here is 5.5, 5.52. So I can just say 5.5. That's 5.5 times. It means that in this particular period, we replaced our stock. We replaced it how many times? 5 times. So you see it measuring the kind of relationship that exists between cost of sales and what? Because cost of sales means that that's the goods that you have sold. All right. So we want to see the relationship that exists between those two so that we can know the number of times that we replaced our goods in this particular period. Do you understand that? Let me also still display the Padlet link for people that are not here and would want to see it. That's the Padlet link there. I will remove the attendance code now. I believe that you have done that. All right, so that's that about that. All right, so we can now move into interpretation of financial statements using ratio. All right, we just have a number of ratios to talk about and then we are done. So interpretation of financial statements using ratio. Don't forget, I told you that the major reason we are doing all of this one ratios and all of that is because of what? We want to interpret financial statements. We want to analyze it. Now, there are 4 major types of ratios when it comes to analyzing financial statements. We have the profitability ratios, we have the liquidity ratios, this is number 2. We have the investment or investors ratio. Then we have the long-term solvency ratio or gearing ratio. Are we together? Now, I'm going to explain it one by one. Now, your profitability ratio measures the effectiveness of the management team. What you're actually doing here, profitability ratio, is how much profit are we making? How profitable are we? To know a company's performance, you want to look at the amount of profit that they have made. But you don't just want to look at the absolute value when they say they have made 1 million naira profit. You want to know how effective they use their resources in order to make profit. Because if the two of us, if we run a business and we make 1 million naira profit, you should not just be, you cannot place the two of us on a pedestal, on the same. You have to look at what I used in order to make 1 million and what the other person used. For example, you know that story in the Bible where you have somebody that gave, when you have somebody that has talents, 5 talents, you have another one, they gave him 2 talents, another one, they gave him 1 talent. You see that the person that had 2 talents, he made another 2 talents. But the person that made 5 talents, he made another 5 talents. To them, those 2 people, they are equal. Why? Because they had 100% profit. You made equal to what you already have. If the person that had 5 talents, if he made 4%, 4 talents, that would be 4 over 5, that would be 80%. Then it would not be as profitable as the person that made 2 talents, because that one made 100%, you made 80%. So you have seen how ratio is. So we are trying to see. So profitability ratio measures the effectiveness of the management team, because the management of a company are the ones that are supposed to what? Make profit. They are supposed to do business in a way that will yield profit, that will increase profitability. So as regards how much they are able to make from profit from the sales and the capital invested. Now, the first one is gross profit margin. Whenever you hear margin, just know that we are representing that thing with sales. I mean, we are looking at relationship between this thing and sales. So margin is what? Sales. So when you see gross profit margin, it is the ratio of what? Gross profit to sales. It's as simple as that. Whenever I see net profit margin, then you know that we are looking for what? The ratio of net profit to sales. So gross profit margin is used to measure the relationship that exists between sales and gross profit, and it is expressed in percentage. So the formula is gross profit over sales multiplied by 100 over 1. GP over sales times 100 over 1. That's your net gross profit margin. Therefore, net profit margin is the same thing. You are looking at the ratio of net profit to sales. It is used to measure the relationship that exists between sales and net profit. So what we are saying here is how much of your sales are you converting to gross profit? And here, how much of your sales are you converting to net profit? So formula for net profit margin is net profit over sales multiplied by 100 over 1. Do you understand that? So that's that. Then we also have return on capital employed. Now, the capital employed of an organization is the difference between total asset minus current liability. It's used to show the amounts that have been invested into the business. Now, there are two ways you invest money or you get money to run your business. Two major ways. Is either you impute money as the owner, that's equity, or you borrow money, that's long-term borrowings, or long-term borrowings or long-term liability. So the addition of these two is your capital employed. So that's the amount of money that you have in the business that you are using to run your business. The equity is the amount of money that was pumped in by the owner of the business, while long-term borrowing is the amount of money that you borrow from outsiders in order to run your business. So return on capital employed is trying to see how efficient are these management, how effective are they, how well are they able to use the finance that is available to them, the money that is available to them, in form of what the owner contributed, in form Oluwatomileyin you see in class, maybe you have slept off, I don't know, in form of what they contributed, but I'm happy that the video is going to be available so that if you slept off, you would be able to go and watch it. So in form of the capital employed is in form of the amount contributed by the owner and money borrowed from outsider. So it's simple. It is simply expressed as what? Profit over capital employed times 100%. So you can calculate capital employed by saying equity plus long-term borrowings, or you can say total assets minus current liability is still the same thing. Why is that? Because your total assets is supposed to be equals to your liabilities. Asset equals to liability plus equity. Don't forget accounting equation that we did. All right. So if asset equals to equity plus liability, then liability is divided into both long-term and current. So you can say equity plus current liability plus long-term liability. So by the time you do A minus CL, current liability, it will give you equity plus long-term liability. Do you understand that? So it's still the same formula. So capital employed, just use total asset minus current liability, and then you are good. So then you divide it by profit and then multiply by 100, you have your ROCE, return on capital employed. Then for the next one, we have asset turnover ratio. Now this ratio shows how the company has been able to utilize its assets to generate sales. All right. So how have you been able to utilize your assets or the money available to you in form of capital employed to generate sales? So your asset turnover, whenever you hear turnover, we are also talking about what? We are most times talking about what? Sales. Because another name for sales is what? Turnover. Because you are selling. How much of goods you are selling. So asset turnover ratio is what? Sales over capital employed. Now let's work on this example. We have sales 45, opening stock, closing stock, expenses, fixed asset, debtors, creditors, purchases. Now the question says calculate cost of sales, calculate net profit, calculate current ratio, calculate working capital, calculate gross profit margin, calculate net profit margin, and calculate the rate of stock turnover. Are we together? All right. So I think for this we can just do a mini trading account here. Trading profit or loss account for the year ended. For the year ended. We don't know the year. So when you want to start, you say sales on credit side, abi 45,000. The reason I'm doing this is because they told us calculate cost of sales. They also told us to calculate net profit. So let's just do it here. We'll get everything that we need. So we still also need to calculate gross profit margin. To calculate gross profit margin, you need gross profit. To calculate net profit margin, you need net profit. Do you understand that? So sales 45,000. Now here, how do you start? I've taught you guys this. So if you were not in class, then go and watch the video. All right. So you have opening stock 20,000, add purchases is 25,000. What do we have again? Nothing. This gives us 45,000. This 45,000 is our cost of goods. I don't have space to write it, but that's cost of goods available for sales. Let me just call it COGAS, cost of goods available for sales. Then we say less closing stock. Closing stock is 30,000 naira. So 45,000 minus 30,000, that gives you 15,000 naira. All right. So this 15,000 naira is your what? Cost of goods sold. And don't forget, another name for cost of goods sold is your cost of sales. So you have gotten number one. Let me tick it. I'll say number one. All right. So the next thing, gross profit. To get here, we say gross profit. To get gross profit, we take a total 45,000 total here. 45,000 total here. Then our gross profit will be total sales minus cost of sales. So 45,000 minus 15,000, that gives us 30,000 naira. Do you understand that? So since our gross profit is 30,000 naira, okay, they did not ask us, it's not part of this. Just so you know what to do. You have to bring your gross profit down. So you say gross profit brought down. How much? 30,000. Put it here. 30,000. Then here you have your expenses. How much is expenses? They gave us sales, opening stock, closing stock. Expenses is 15,000. So come here, say 15,000. All right. So your net profit will be equals to gross profit minus expenses. Gross profit is 30,000. So it means that your net profit is gross profit minus expenses. That's 30,000 minus 15,000. So that's 15,000 naira. All right. So net profit is number two that they told us to look for. So let's label it number two. The next thing is current ratio, but we have not done current ratio, so let us leave that for now. The next thing they told us to find is working capital. I've not explained working capital here, but we have done working capital before. And what's working capital? Your working capital is current asset minus current liability. So you are trying to see how much money you have to settle your day-to-day expenses. That is, if you use your current asset, which is money that you can get within this year, and you use that money to settle your current liabilities, will you have any more money left? Do you understand that? So that's the money used for the day-to-day running of your business. All right. Then we have gross profit margin. We can calculate gross profit margin. Of course, you can calculate current asset too. All right. To calculate current asset, we'd have to add sorry, to calculate working capital, we have to add current asset, then deduct current liability. So let's look at it here. What are the current assets we have? Sales opening stock, no. We have closing stock. That's current asset. So I will come here, I will say closing stock of 30,000 naira plus any other current assets. Debtors, any other one, no. So I'll come here 30,000 plus 10,000 naira. That's my current asset. Plus minus current liability. The only current liability that we have here is what? Our creditors, which is 5,000 naira. So we say minus 5,000 naira. That's 30 plus 10, 40,000 naira minus 5,000 naira. Means that our working capital equals to 35,000. In the same way, we can calculate current ratio, because current ratio equals to current assets over current liabilities. As you can see it here, so that will be equals to 40,000 over 5,000. 40 divided by 5, that gives us 8. Sorry, that's 8 now. So that's 8. So our current ratio is 8. You can put it 8:1. Then they told us to find gross profit margin. Gross profit margin equals to gross profit over sales multiplied by 100 over 1. Our gross profit here is 30,000, our sales is 45,000. So you say 30,000 naira over 45,000 naira multiplied by 100 over 1. So what we are just saying here is that if we have, like, out of the 45,000 naira sales, so 30 divided by 45 multiplied by 100, that's 66 number 2 over 3%. 66 number 2 over 3%. So what we are saying is we are making 66 number 2 over 3% gross profit from our sales. So we are converting sales. So which means that our cost is low as compared to our sales. That's why our gross profit is high. So now let's look at net profit. I think after it is net profit. Net profit margin is equals to net profit over sales multiplied by 100 over 1. Abi? So what's our net profit? We have 15,000, abi? And our sales is 45,000. we say equals to 15,000 over 45,000 times 100 over 1. So when you do 15 divided by 45, you have 33 over 1 by 3%. 33 over 1 by 3%. So that's your net profit margin. Then don't forget, we now have rate of they told us to calculate rate of stock turnover. All right. Your rate of stock turnover equals to cost of goods sold all over average stock equals to, what's our cost of goods sold? 15,000 divided by, we don't know our average stock, so let's calculate it. Average stock equals to opening stock plus closing stock over 2. What's our opening stock here? Opening stock is 20, closing stock is 30. So we have 20,000 plus 30,000 divided by 2. That's 50,000 divided by 2 equals to 25,000. So rate of stock turnover is 15,000 over 25,000. By the time we do 15 over 25, it gives us 0.6. It means that the number of times that we replaced our stock was actually less than one time. We did not replace our stock up to one time. Can you see? So 0.6 times. Do we understand that? All right, because of our time, I think we can stop here. Then in our next lecture, we'll complete this topic. We'll do liquidity ratios, investment ratio, and long-term solvency ratios. All right, so I'm going to drop some questions on this particular topic. All right, I'm going to drop it on the Padlet because you can see the Padlet link, all right, below the screen. Just type it out on your browser and then come there. All right, so you see all questions that we have been posting. I'll send questions on these too so that you can practice over the weekend also. So yeah, that's that about that. In our next lecture, we move on and complete every other thing. So thank you so much for joining. It's good to have you, and see you at the top. Do well to take care of yourself. Enjoy your weekend around your books. All right, so enjoy your weekend with your books. Thank you. So once again, the Padlet is there. Sorry, I dropped a question on Padlet. I hope I didn't drop it in the wrong place. Have a little practice question on your Padlet, go there. I'm going to drop more questions for the weekend. So do well to take care of yourself and have a great weekend. Bye.